morning, friends. I am Dr. Balarubi, Assistant Professor in the Department of Economics. Students, in today's class, we are going to discuss about venture capital finance mutual funds. See, in the starting of the class, we will discuss about the operating a venture capital fund. Then we will discuss about the factors to consider for venture capital investment. Finally, we will discuss about the features of venture capital investment. The venture capital funds are pooled investment funds that manage the money of investors who seek private equity stakes in startups and small to medium-sized enterprises with strong growth potential. These investments are generally characterized as a very high risk, high return opportunities. In the past, venture capital investments were only accessible to professional venture capitalists, but now accredited investors have a greater ability to take part in venture capital investment. Venture capital is a type of equity financing that gives entrepreneurial or other small companies the ability to raise funding before they have begun operations or started earning revenues or profits. Venture capital funds are private equity investment vehicles that seek to invest in firms that have high risk, high return profiles based on a company's size, assets, and stage of product development. Venture capital funds differ fundamentally from mutual funds and hedge funds in that they focus on a very specific type of early stage investment. All firms that receive venture capital investment have high growth potential or risky and have a long investment horizon. Venture capital funds take a more active role in their investments by providing guidance and often holding a broad reach. VC funds therefore play an active and hands-on role in the management and operations of the companies of their portfolio. So let us concentrate on the operating a venture capital fund. See, venture capital investments are considered either a seed capital, early stage capital, or expansion stage financing depending on the maturity of the business at the time of the investment. However, regardless of the investment stage, all venture capital funds operate in much the same way. Like all pooled investment funds, venture capital funds must raise mainly from outside investors prior to making any investments of their own. A prospectus is given to potential investors of the fund who then commit money to that fund. All potential investors who make a commitment are called by the funds operators, and individual investment amounts are financed. From there, the venture capital fund seeks private equity investments that have the potential of generating large positive returns for its investors. This normally means the fund's manager or managers review hundreds of business plans in search of potentially high growth companies. The fund managers make investment decisions based on the prospectus mandates and the expectations of the fund's investor. After an investment is made, the fund charges an annual management fee, usually around 2% of assets under management. But some funds may not charge a fee except as a percentage of returns earned. The management fees help pay for the salaries and expenses of the general partners. Sometimes Fees for large funds may only be charged on investor capital or decline after a certain number of years. Venture capital funds are pooled investment vehicles that provide capital to startup in exchange for equity. Venture capital funds invest in startup in exchange for an ownership stake in each company. Venture investments are riskier than other asset classes, but also carry the prospect for outsized returns. VCs raise money from a network of limited partners who can be wealthy individuals or institutional investors. Venture capital funds make money when a portfolio company exists, typically within 10-year time frame. Then let us concentrate on the factors to consider for venture capital investment. See, there are some character of the business partners. The people behind an idea or company, and more importantly, is extremely important. We could have the best idea in the world, but it might never get off the ground with the wrong team in place. So their reliability, honesty, potential for a long-term relationship and work ethic all come into play. A team who understands their roles and performs them with love and enthusiasm is very hard to beat. So we have to feel completely confident in the abilities as well as the character of the team before investing. So let us concentrate on the capacity of the business partners. So we can just fill startup roles for the sake of creating a team and launching. We need to make sure each person is highly qualified and possesses the ability to take the business to the next level. For example, a CFO with limited financial experience is a disaster waiting to happen. While a CMO with limited marketing experience is a severe handicap. There has to be a capable team with potential to grow the business and to carry it to high levels of success, explains the author. So, experience and the past track records play a major role in providing a little more confidence. Building greatly increases the odds of securing VC money. Then, innovative idea. Every new startup is something and is played out. With less than 1% of all US companies ever receiving VC, we need to stand out, and the way to do that is by having something truly innovative and unique. We are only going to attract the initial interest if our idea is something that the VC has not been pitched several times already. So let us concentrate on the communal benefits. The startup come and go, and while nobody has an exact percentage, most of the people put the startup failure rate between an 80% and 90%. The few startups that experience massive success all solve a problem. So let us discuss about the main features of venture capital investment. First feature is high risk. Second one, lack of liquidity. Third one, long-term horizon. Next one, equity participation and capital gains. Next one is venture capital investments are made in innovative projects. And finally, the last one is suppliers of venture capital participate in the management of the company. So it is private or institutional investment made into early stage or startup companies As defined, ventures involve risk in the expectation of sizable gain. Venture capital is money invested in business that are small or exist only as an initiative, but have huge potential to grow. The people who invest this money are called venture capitalists. The venture capital investment is made when a venture capitalist buys shares of such a company and becomes a financial partner in the business. Venture capital investment is also referred to risk capital or patient risk capital, as it includes the risk of losing the money if the venture doesn't succeed, and it takes medium to long term period for the investment to fructify. So it comes from institutional investors and high net worth individuals, and is pooled together by dedicated investment firms. It is the money provided by an outside investors to finance a new, growing, or troubled business. The venture capitalist provides the funding, knowing that there is a significant risk associated with the company's future profit and cash flow. Capital is invested in exchange for an equity stuck in the business rather than given as a loan. So students, these are the important aspects in the today's class. Thank you.